This is Inside the Wolf's Den, an entrepreneurial journey with Shawn and Joni Wolfswinkel.
Welcome back to Inside the Wolf's Den with your hosts, Shawn and Joni Wolfswinkel. Today we have a special guest with you. It's actually a treat. Jay Scott is in the house inside the Wolf's Den. How are you, Jay?
I am doing great. Thanks for having me, guys.
Well, thank you for joining us. So just a quick bio on Jay. Jay Scott is a partner at Bar Down Investments, an entrepreneur, investor, advisor, and author. Jay is a business guy by education and spent much of his early career in Silicon Valley, where he held management positions at several Fortune 500 companies, including Microsoft and eBay. In 2008, Jay and his wife, Carol, quit their corporate jobs, moved back east, got married, started a family, and decided to focus on real estate investing. In the past 15 years, Jay has personally transacted over $150 million in property all around the country. Jay is a former host of the top-rated BiggerPockets Business Podcast and currently co-hosts the widely acclaimed podcast, Drunk Real Estate. He is the author of 5 books on real estate investing, including the best-selling The Book on Estimating Rehab Costs. His book have sold over 500,000 copies in the past 10 years and have helped investors from around the world get their start with real estate. He is also a strategic advisor and mentor to several companies, business owners, and entrepreneurs. He is co-founder of Apartment Addicts, where he helps aspiring multifamily investors achieve their financial goals. Again, thank you for joining us. Let's take this back a little bit. Where did this all get started? How did you get interested in real estate investing?
It was all kind of by accident. So like the bio said, my wife and I were both in the tech industry. And in 2008, we decided to get married. And when we decided to get married, we realized that working the 80-hour weeks, she was traveling 3 weeks a month. I was traveling 2 weeks a month. We never would have seen each other. It wasn't the right environment to raise kids. It wasn't the right environment to build a family. So we decided very quickly after we got engaged that we just wanted to do something that was more conducive to the lifestyle. We wanted to be able to raise our kids, not to have to put work before our family. We wanted to put family first. And so we quit our jobs. We moved from the West Coast to the East Coast, and we said, we'll figure it out. Mm-hmm. And so we took 3 months before the wedding to kind of get settled into our new house. And it was the first house we had ever purchased. We were in our mid-30s, and we had never bought a house before. And so we decided, let's figure this out. And one morning during those 3 months, my wife was in the basement watching HGTV. And there was a flip show on TV, like there was on pretty much every channel, every hour of the day back then. And she said, let's flip a house. And not as a business, not as something to do as real estate investor. She's a design person. She's very creative, and she just wanted something fun to do. And so I said, okay, let's give it a try. And so in summer of 2008, we went out and we learned how to flip a house, and we ended up buying a second and a fifth and a 10th and a 50th. And before we knew it, we were, real estate investors.
Awesome.
That's amazing. Yeah. Sounds a little like Shawn and I when we got started that first show.
Yeah. So to tell us, what experiences shaped your career? How did you really, parlay those single family homes into, I think, a lot of what you're involved in today with syndications and multifamily investing? And so kind of how did you take that leap?
Yes. So I've never considered myself a real estate guy. I do invest in real estate, but I've always considered myself a business guy that just happened to fall into the real estate world. And I like to say that with me, the underlying product, the underlying inventory, it happens to be real estate, but I'd be just as happy if I owned a restaurant or a car dealership or a tech company, or I was selling any other product. Because for me, the thing I really enjoy is the business piece, the strategy piece, the higher level stuff. It's not the nuts and bolts of real estate that I like. In fact, I hate the idea of going to a property that's under renovation. I hate the idea of ever swinging a hammer myself. I hate the nuts and bolts of the buying and the selling process and dealing with all that. I like the business strategy piece. And in real estate is, to some degree, it's not a team sport. It's something you can do yourself. My wife and I flipped together for a long time, and we did have a team. I mean, we had people around us that we were managing, and we had contractors and we had project managers. We had agents on our team, and we had lawyers and all those other people that you need on your team. But it wasn't scalable, or it wasn't easily scalable. We got up to doing about 40 houses a year, which was a decent number. We could have gotten higher, but the systems and processes it takes to get more than that it's not conducive to scaling a business in the traditional sense. But what is a business in real estate is doing the larger deals. And so multifamily, commercial real estate kind of always interested me from that perspective. I always liked the idea of being able to build a team where I wasn't necessarily running the whole team. I might technically be in charge, but there are a number of other people on the team that are the absolute experts at what they're doing, and they can run each part of their piece of the business individually with or without me. And so the reason I love multifamily is because there are a couple of things in this business I'm really good at. I'm good at underwriting. Turns out I'm good at capital raising, but there are also things that I'm really not good at and really dislike. So finding deals, I'm not good at. The asset management, which is the day-to-day CEO of the projects, dealing with the renovations. I don't like dealing with the day-to-day renovations. And in the single family world, I had to kind of be involved in all of that myself. In the multifamily world, we have partners, and I focus on the things that I'm really, really good at. And my partners focus on the things that they're really, really good at. So it's much more like a larger business environment than it is kind of like a sole proprietorship or just one person running a business.
That's awesome.
Yeah. So I'm guessing you don't like property management.
I hate. I've always said if there's one business I would never ever start, it's property management. It's low margin. It's high touch. It's dealing with people, which it's not my favorite thing in the world. I have the utmost respect for my property management teams because it's a job that I could never, ever imagine doing myself.
Exactly.
Well said. Well, now that we're talking about challenges, can you share any challenges or setbacks you've encountered along the way on your journey and how you've overcome them?
Yeah. So for me, the biggest one is just I've always been tremendously conservative. I've never been someone who likes to take risks. Luckily, I've aligned myself with people who are more risk-taking than I am, less conservative than I am. They recognize how conservative I am and they push me. So my wife was the first. We did a few deals a year, 2008, 9, 10. In retrospect, we turned down a lot of really good deals because we were being so conservative. And so luckily, after a few years, I let her push me out of my comfort zone a little bit, and we started doing more houses and we grew the business a little bit faster. And then more recently, my partner, Ashley Wilson at Bar Down Investments, she's also somebody who is very aggressive. She's conservative with the numbers, but at the same time, she sees the bigger picture and she thinks longer term. And so she often finds deals that I would say no to just in a heartbeat because one number didn't work out here, one number didn't work out there. But she'll come to me and she'll say, well, let's get creative about this and let's think about how we can overcome the risks or the challenges or whatever that one issue is. And so working with other people that can really get me to move out of my comfort zone, get me to be creative, get me to think about how to say yes as opposed to how to say no. I think my default is always saying no. And so it's tremendously important. It's been tremendously valuable for me to work with people whose default is to say yes.
Right.
It's good balance.
Yeah. Absolutely.
Joni and I are a lot like that. We balance each other out pretty well.
Right.
So,
it's good to have both sides.
Yeah, exactly. So, I mean, one of the main reasons we really sought out to get you on the show was, I think you have a ton of knowledge. I think you've been studying a lot. I listened to your podcast, Drunk Real Estate, and I hear, I love your guys' updates on the market. And so one of the things we really wanted to ask you, some of the questions, kind of having the crystal ball, but
if Jay had a crystal ball.
Yeah. But one question I wanted to ask you is, from your perspective, should an investor, is now a good time to buy with everything that's going on and some of the headwinds and all that? What's your thoughts on waiting, or should investors buy now?
So let me start with, it's always a good time to buy as long as you do it right. And the definition of doing it right is going to change based on a lot of things, especially the economy. And so 5 years ago was a great time to buy. 15 years ago, the middle of 2008, when I started, probably the worst part of the recession, was still a great time to buy, as long as you heeded certain rules and were cautious in the right ways. And so today, I believe, is still a great time to buy, but a few things that people need to do if they're going to buy real estate today. Number one, recognize that you're going to see a lot less cash flow today than you did even 2 years ago. Cash flow to a large degree is influenced by interest rates. So we collect our rent, we pay a bunch of money on expenses, and then there's money left over. And the money that's left over goes to two things. It goes to our mortgage and it goes into our wallet. It's our profit. And as interest rates go up, the more our monthly mortgage payment goes up and the less goes into our wallet, less goes into our bank account. And so with higher interest rates, we're going to see less cash flow. And so people need to recognize that if you need cash flow to live, you're going to have a hard time doing that today as easily as you did 2 years ago or 5 years ago. So what I encourage people to do is be realistic that you're not going to get a lot of cash flow today, but that doesn't mean you shouldn't be buying real estate. Cash flow is only one benefit of buying real estate. There are a number of others. Appreciation. And I'm not talking about just buying and holding forever, because while real estate does appreciate, historically it appreciates at pretty much the rate of inflation. So holding real estate long term will allow you to kind of preserve your wealth, but not necessarily grow it just by holding it. But there's also this thing called forced depreciation, where you can do strategic renovations. You can improve a property in a way that makes it worth more than it was when you bought it. Additionally, tax benefits. A lot of us ignore tax benefits. I ignored the tax benefits until I was in my 40s and started paying a lot of taxes. And it was that point that I realized how valuable understanding the tax implications of real estate were, and how real estate could be used to really reduce my tax situation, put a whole bunch more money in my pocket, whether it's for a couple years or long term, and really compound that savings. And then finally, just the pay down of the loan. So what we call amortization. So having your tenants pay down your loan is a great way to build wealth over time. And so, yeah, we're seeing less cash flow these days. So the first thing I recommend people do is be realistic about the cash flow that you need, about the cash flow that you're going to get, but also be cognizant of those other parts of the business that are going to generate long-term wealth for you over and above cash flow. So that's number one. Number two, people need to start thinking longer term. So it used to be that we could buy a property, we could flip it, we could renovate it and flip it in 3 months or 6 months or 12 months. You still might be able to do that. But the problem is that I suspect that the market is going to get softer over the next year. And so flipping houses right now is more risky. If prices go down between now and when you sell that house, let's say they go down 15%, and let's say you expected to make a 15% profit, well, now you've effectively done a break-even deal. Now, there are some areas where you can be more confident that the market is doing well, where you might be more confident flipping. But in general, I'd be a lot more cautious flipping houses today than I was a couple years ago. So thinking longer term, buying properties that you plan to hold for 3 years, 5 years, 7 years, 10 years. The nice thing is there's been no 10-year period in the history of this country where the value of real estate has gone down. For the most part, there's been no 5-year period. Then it's not completely true. 2008 to 2013 or 7 to 12, we did see values go down in a lot of places. But even for most 5-year periods in this country, real estate goes up in value. So as long as you're comfortable holding something for at least 5 years and ideally for 10, if in a worst case scenario, you're going to make money. And so what I would recommend to anybody that's buying today, because prices are really high, make sure you're in a position where you can hold those properties for 3 or 5 or 7 or 10 years, because I'm confident that over that 5 or 10 year period, prices are going to be even higher than they are today. And then the third thing I would say, and this is super important, is even if you have that time horizon on your mind, you plan to hold for 3 or 5 or 7 or 10 years, keep in mind that you may need to weather some storms in that time period. You may have to deal with interest rates going up. You may have to deal with values going down for some period of time. You may have to deal with tenants paying less in rent or vacancies going up. There are going to be challenges you're going to face along the way holding it for 5 or 10 years. And so you need to make sure that you can withstand any of those challenges. You can handle any of those headwinds. And so that means getting longer term loans and making sure you have some cash reserves and making sure your numbers support a little bit lower rent or a little bit higher vacancy. Whatever it is, make sure that you can withstand those storms. But if you can withstand those storms, again, if you can hold on for 5 or 10 years, you can be almost certain that your property is going to go up in value.
Mm-hmm. That's awesome.
That was a great answer.
Yeah.
And I think, I was going to say to holding long term, it's going to come down to sometimes what debt and what, I think that's where a lot of people are getting into trouble right now. We're going to get into that. But, as far as what is your take on interest rates right now? In your opinion, do you feel they're headed? I know, the 10-year treasury, it keeps going up, but so what's your thoughts on interest rates?
So it's interesting. I would have thought that interest rates would have started coming down by now. Mm-hmm. The first thing people need to realize is that all the things that people assume control mortgage rates, and when we talk interest rates, I assume you're talking mortgage rates. Mm-hmm. Yes. People have a lot of ideas on what controls mortgage rates. The government controls mortgage rates. Banks control mortgage rates. At the end of the day, what controls mortgage rates is this thing called the 10-year treasury yield, which is government bonds. Mm-hmm. So government sells bonds to raise money to basically run the country. Mm-hmm. And the value of these bonds or the yield, what these bonds are paying to investors is ultimately what controls mortgage rates. And so that's not something that the government has direct control over. Government can set these other interest rates, what we call the federal funds rate. That's the thing that when the Fed meets every month or two and they say we've raised interest rates to 4% or 5% or 5.5%, that rate is kind of this rate that banks lend to each other at. That's not the rate that affects mortgages. And while when that rate goes up, mortgages often go up, it doesn't have to work that way. Unfortunately, it's this 10-year treasury rate that influences mortgages. And what we've seen over the last couple months is that this 10-year treasury rate has kind of gone through the roof. Mm-hmm. It's right around 5%. It hit 5% a couple of weeks ago for the first time since 2007. And that's why we're seeing mortgage rates the highest we've seen since around 2005, 6, 7. And so the question we need to be asking is, where are these 10-year treasury rates going over the next few months? And while we don't know for certain, the reality is that there's been a lot of pressure on those rates going up. What drives those rates up? Well, people not being scared. Mm-hmm. Investors not being scared. Investors being comfortable investing in the stock market. Investors being comfortable investing in real estate. Investors being comfortable investing in businesses or gold or whatever else it is. Because when they're not investing in treasuries, treasury yields go up. Mm-hmm. And when treasury yields go up, mortgage rates go up. So long story short, as long as the economy is going well, and investors are confident and people are confident that we're not heading into a recession, I think mortgage rates are going to stay high or even continue to go up. The day we see reason to believe that we're heading into a more pronounced recession, the day people think that stock market is not a good place to be putting our money anymore, or real estate's not a good place to be putting our money anymore, the minute people and especially investors start getting really scared about what's happening in the economy, they're going to start piling into treasuries because that's a very safe investment. And when more people invest in treasuries, the yield on those goes down. And when the yield on those goes down, mortgage rates goes down. So I know that's a really long explanation, but long story short, I think as long as the economy is going strong and as long as investors are confident that things are good, we're going to see high mortgage rates, and they could even go higher than they are today. As soon as we see a recession kind of kick in, I think we're going to see mortgage rates drop very quickly.
Yeah. Do you see real estate values holding in the single family space? I
do. So over time, over the last 120 years or much of the last 120 years, what we've seen, I said this earlier, was that real estate values tend to track inflation. Mm-hmm. And if you look from like 1900 to 1996, that was almost a direct correlation. I mean, if inflation went up a little bit, real estate went up a little bit. If inflation went down a little bit, real estate didn't grow as much. And so there was a very direct correlation between inflation and real estate. And then in 1996, values started to soar well above inflation. But then we had 2008. And 2008, basically values took a big hit, and the value of real estate came crashing down, basically back to that trend line, that inflation trend line. And it made sense because, again, over long periods of time, the two should kind of converge and look similar. And since 2013, we've had this divergence again, where real estate values have again gone far away from that trend line, far away from that inflation line. And so the first thing you think is, okay, it has to come crashing back to that line, and values are going to go down tremendously. But there are other things at play, and what people need to keep in mind is, yes, I believe that real estate and inflation, those two lines are eventually over the long term going to converge, but that doesn't mean things have to come crashing down and those two lines have to converge this year or next year. I personally think that real estate's going to stagnate. The values in real estate, especially a single family market, are going to stagnate over the next 5 or 7 years, and inflation is going to kind of catch up. And so those two lines will converge again, but only because the real estate line is staying flat and the inflation line is going to continue to rise. And the reason I believe that is that there are a lot of pressures on real estate in an upwards direction. There's very low supply. There's very high demand. There's so many people with mortgages. 82% of people have mortgages under 5%, that they don't need to sell their house, and they're not going to, as long as they have to sell and then buy another house with a high mortgage. They're going to wait till rates come down. And so between all of these things, I think values are propped up, and I think they'll stay propped up long enough for those two trend lines to converge again. So I think for the next 5 to 7 years, we see flat real estate prices, which is not a bad thing. I know we've all kind of gotten used to real estate going through the roof, but again, there's other benefits of real estate besides just appreciation.
Right.
And so if we can take advantage of those, I think the flat prices over the next several years isn't necessarily going to be a bad thing. Right. But I do see values being flat for a while.
Yeah.
Yeah.
Let's get into your space and where you're playing a lot in the multifamily and commercial space. How about answer that same question there, as far as what are you seeing as far as a lot of the debts being, is coming due. People did maybe valuations or underwrote the deal at, interest rates that were a year ago. And where do you see values in that space headed, and a lot of the inventory that's on the market? It seems like a lot of people are in trouble. And so, but wanted your 2 cents on it.
Yeah. I guess long story short, there are a lot of people who are going to be screwed. So sorry for the language, but yeah, a lot of people that are going to be in a bad position, but not all of them.
Yeah.
So you hit the nail on the head when you said interest rates changing over the last year and a half, and that's what's driving most of the distress that we're seeing in the multifamily space. And when we talk about commercial, I'm specifically talking about multifamily here because every part of commercial, every asset class is a little bit different.
Right.
But in multifamily, what's driving a lot of the distress we're seeing are those investors who got floating rate loans, basically loans where the interest rate that they have to pay is going to fluctuate with the mortgage rates out there and other things. And so those borrowers are in a lot of trouble. Those borrowers account for maybe 30 to 35% of the total multifamily loan volume that's out there. Wow. The other 65 or 70% are in long-term fixed rate loans. If they got in before last year, those loans are probably under 5%. Most of our properties that we got into before last year in the 2 and 3% range, locked for 5 or 10 years. And so I think there are a lot of investors in our position where they don't really have those concerns. But when you have even 30% of the market that's in major distress, like we currently do, 30% of a market that's a $2 trillion market is pretty significant. And so there are definitely people that are running into issues. We've seen a number of our colleagues in this space who have started to cut back on distributions to their investors, who have done what are called capital calls, where they ask their investors to put in additional capital into the deal because basically they're not making ends meet. We know a few people that have lost properties to banks and a few more that are probably coming very soon. And even those who are doing well, what we've seen is that values have started to drop. And so if you bought a property in the last 3 years, you may have been hoping by now that your property is worth 20 or 30 or 40% more. But when the value of real estate across the board has dropped 20 or 30% over the last year, that means that a lot of properties that were bought, even if the interest rates were low, even if everything is otherwise okay, may be underwater. And so there's definitely going to be some distress. I think multifamily is well positioned over the next few years. There's not enough supply currently. I think a lot of people, especially in the single family world, who are experiencing distress and have to sell because they're moving, or they're getting a divorce, or they're losing their house because they can't make their mortgage payment because they lose their job, whatever it is, those people aren't going to buy a new house at the current rates. And so I think what we're going to see is over the next couple of years, anybody that sells their house, not anybody, but a lot of people that sell their houses are going to be choosing to rent instead of buying another house. And so I think the home ownership rate over the next couple of years is going to drop drastically. And all of those people that are choosing not to buy a new house and that are choosing to rent, most of them are going to go into apartments. And so I think there's going to be good demand for apartments over the next couple of years. And this goes back to what I was saying earlier. When's a good time to buy if you can withstand the storms? And so I think any of the multifamily operators out there right now that can withstand this current storm of interest rates and difficulty refinancing, those that can survive for another year or two are probably going to be well positioned.
Good point.
How long are majority of the loans? Do you see 5 or 10 year, or weren't there a bunch at 3 as well, or wasn't that a popular?
Yeah, there are basically 2 types of loans in the multifamily space. Most of the fixed rate loans are 7, 10, or 12 years. And so those investors, because a lot of those properties, a lot of multifamily properties have been purchased in the last few years. Anyone with a fixed rate loan, again, 65, 70%, are probably in a pretty good space. But then there are these things called bridge loans. And these are the loans that investors typically get when they're buying a property that needs renovation, that's in some type of distress. Basically a loan that will get them to the point where they can renovate the property, get it tenanted up, get it fully occupied, and then they refinance into that fixed rate long-term loan. A lot of people bought properties in 2020, 2021, beginning of 2022 with these bridge loans thinking, okay, I'll get everything renovated and I'll refinance into a longer term loan. But these bridge loans are the ones that tend to have interest rates that fluctuate. And so they bought these with interest rates down at 2%, 3%, and now they're paying 7%, 8%, 9%. And so anybody that's in one of those loans probably is within a year of having to refinance. And when values are down, you can't refinance out as much as you took out in the first time you got a loan. And so if you want to refinance, you pretty much have to bring money to the table. In addition, there's these things called rate caps, which is basically an insurance policy that's common in the multifamily world, where if you get a loan that has a floating rate where the rate can go up and down with the market, you can buy this insurance policy that basically says you can cap how much you pay in rates. So if you buy a policy when you're paying 3% or when the market's at 3%, if the market goes above 5%, you're only responsible for paying a 5% interest rate. Anything above that, the insurance company will cover. And so a lot of us who got these bridge loans with floating rate debt a couple of years ago, we got these insurance policies. And back then you could get these insurance policies at $30,000 a year, $40,000 a year, $50,000 a year. These policies tend to expire after 1 or 2 or 3 years. And these days, because rates have kind of gone through the roof, there's a lot of volatility. What we're seeing is to renew these policies, $500,000, $700,000, $1 million.
Wow.
So just to give a real example, we bought a property in September 2020. We bought this rate cap, this insurance policy. We were paying $30,000 a year. We had to renew it 2 weeks ago, and to renew it for the next 2 years, we needed to pay over $900,000.
Whoa.
And so that was $900,000 that luckily the property has been doing well. We had money in reserves. We started saving for it last year when we expected it to happen this year, but it's still a big hit. And there are a lot of investors out there that can't afford that type of hit. And so while everybody's saying interest rates are the thing that's going to kill investors in the multifamily space right now, it's these rate cap insurance products that are actually hurting investors even more.
Yeah.
So I was hearing all these people that would say, "Hey, well, I got insurance, and if you didn't, you were a fool." But even if you got it, it sounds like it's
You're still facing.
Yeah.
issues.
Did you when you underwrote it? What did you guys even factor? Like, did you factor? I'm just curious, like from a business perspective, how much did you factor the insurance going that much up, or did you?
So we absolutely factored it into the equation, but nobody expected, and when I say nobody, at least we didn't expect rates to jump up 5 percentage points in 2 years. So we didn't factor it in enough. And so last year, I mean, the nice thing is we knew a year ago that this was happening. Anybody that had a rate cap expiring last year at the end of the year, for example, this all happened so fast that they probably didn't have time to prepare. We knew a year in advance before we had to buy our new one. So we had time to go to our investors and say, hey, we're going to cut back on distributions for a year so we can save up. We saved money from property operations. We kept extra money in reserves. So we had a year to prepare, and we were okay. But there are a lot of investors who because rates went up so quickly, just didn't have time to prepare and were caught off guard and didn't have the money.
Yeah. Wow.
I know two of the largest foreclosures already have been in Houston. And so I felt bad for the limited partners and people that lost. And I think you guys did, I think Mauricio or somebody on your show, you guys talked about what was the, just protecting yourselves if you are a like general partner and putting deals together, just what you should have done on the front end just to protect yourself.
Exactly.
Legal wise. Yeah.
Yep.
Yeah. So, do you have a question?
I was just going to, are you done with the
Go for it.
I was just going to talk a little bit about the lessons learned, which I'm sure there's plenty of those that you can talk about.
Just shared a couple already.
Yeah. But what are some valuable lessons you've learned throughout your career?
So I've learned so many lessons. I could put them in buckets.
Write a book.
So let's see. The most benign, but probably most impactful financially for me was the value of holding long term. So I flipped 450 or so houses. My wife and I flipped 450 or so houses, and I like to say that I have 450 regrets in this business. Basically, I look back at how much those houses would have been worth, even if I couldn't have kept all of them, even if I could have kept 1 out of 3 or 1 out of 4. I mean, that would have added tens of millions of dollars to my net worth right now, because again, real estate goes up in value over time. But I got so addicted to getting those big buckets of cash every few months when a property would sell, that we just kept flipping them, and we didn't hold them. If we did buy a rental, I would property manage it myself. And then I'd get annoyed with the tenant after about 2 months and say, okay, we've got to sell this thing. So I guess that's my second lesson, is don't self-manage if you don't have the right mentality, because it'll make you make the first mistake, which is selling too quickly. So that's probably the most benign thing. I mean, it's not going to kill you selling too soon, but it certainly will impact your bottom line. The things that have kind of hurt me the most are bad partnerships. So I look back and I've had some really good partnerships, including the one I'm in now. But we've had some bad partners over the years as well. And bad partners not only are going to cost you money, but the stress and the time and the frustration is really, I mean, it's like a marriage, a partnership, a long partnership's like a marriage. And luckily I've never gone through a divorce, but I just imagine like the toll a divorce takes on you. Every time you have a bad breakup with a partner, you're going through that.
Right.
And so I've had some real stressful times over the last 15 years with partners that I probably jumped in with too quickly, too much. And so in retrospect, I vet my partners and I take those relationships a lot more slowly now than I did at first. And so lots of my mistakes are in that realm.
Yeah.
You're not alone. So yeah, we got some deep scars too. So along the way, but scaling was like a huge topic for the last 3-4 years, and that's all you heard about, and scaling your businesses. I don't hear about it as much anymore today.
Bigger's
but
not always better.
What just especially in the climate we're in today, and the from your business perspective, whether it be scaling your single family flip business or scaling in multifamily as far as acquiring stuff, what's some tips you would give investors out there that are looking to scale and grow right now?
Yeah. Partners. So I think the most important thing to scaling is relinquishing control. And that's the hardest thing for a lot of us as entrepreneurs. We want to have these businesses that are bigger and more scalable. But at the same time, what makes us great entrepreneurs is that we don't trust other people and we like doing things ourselves. And I think to really scale, number one is you really have to be able to learn to trust other people or manage other people. And it doesn't have to be partners. You can be partners. It can be employees. It can be contractors. It can be people you pay commission to. It can be virtual assistants. There are lots of ways to grow and scale your business. But you need to learn to do that. Number two, as you bring more people in, you really need good systems and processes. So the thing that I see setting businesses back the most is that they get to the point where they can bring in partners, they can bring in employees, or they can bring in contractors, and they'll spend 6 or 12 months training those people, getting them really efficient, working really well, and those people leave. And now they have to start that process over.
Right.
And they can never really scale because they keep replacing good people with new people that they have to train up. And so really documenting your systems and processes and making the positions in your business replicatable, making the positions in your business, basically you can bring somebody in tomorrow and they have a process document or a process binder that they can read through with checklists that show them how to do their job, so that you don't have to take another 6 months out of your life to train another person who could leave in 6 or 12 months. So systems and processes is a huge one. Making things, I mentioned the word replicatable, but making the things replicatable is huge as well. So we learned in the flipping business, if you want to do single family at large scale, you really need to replicate your processes. So when we were flipping 40 houses a year, we were using the same cabinets, the same countertops, the same flooring, the same paint colors. So that way our contractors never had to ask us what they were using in the house. We never had to go out and pick new materials. It was saving a ton of time. At the same time, we were using the same closing attorneys. We were using the same inspectors. We were using the same appraisers. We were using the same contractors. We were using the same contracts and documents. Basically, we put our business on autopilot because every transaction looked exactly the same for the most part. And that allowed us to free up our time, that time that would have been taken to customize each transaction, to free up our time on focusing on getting more deals or raising more money or whatever that next thing was. So systems and processes, scaling with people, replicating things. And then the fourth piece I'll point out is really division of responsibilities. So if you look at any big company, I worked at Microsoft and eBay for a long time. I've worked at a bunch of tech companies, but if you've worked for any big company, you know that everybody has a job and there are lots of different divisions. So person that works in the marketing department isn't writing code, and the person that's doing sales isn't doing QA and
right.
whatever. Everybody has a job, and you have different divisions, and so you need to know what you're good at, and you need to know what other people on your team are good at, and you need to divide the responsibilities in a way that people are focused on what they're good at. And so in my flipping business, we basically had 4 pieces. We had acquisitions, we had renovations, we had raising money, and we had selling the properties.
Mm-hmm.
And so everything we did was basically in one of those 4 buckets. And so when my wife and I ran the business, I was good at finding deals, I was good at handling the renovations, and I was good at raising money. My wife was really good at the networking, so she could find deals and sell deals.
Mm-hmm.
And so we broke the business up into these pieces, and she took 2 pieces. I took 2 pieces. She hired some people. I hired some people. We created systems and processes for those people for each of those 4 parts, and we made everything as replicatable as possible. And that's how we scaled our business.
Awesome.
Great. Sounds a little like us. I would get along with your wife.
You probably would.
And you and I get along.
Yep.
Yeah.
So in conclusion, we ask 2 questions to our guests. So if you were just starting out and could go back in your early 20s, what advice would you give yourself?
Start sooner.
Mm-hmm.
Don't wait. There's it's not a secret, because there are no secrets in this business, but the closest I've come to hearing a secret in this business, or coming up with a secret in this business, is this idea that I meet 2 types of people. I meet 95% of people never done a deal, have never done a real estate deal, want to do a real estate, but have never done a deal.
Mm-hmm.
Other 5% of people I meet have done 5, 10, 20, 50 deals. There's one type of person I never meet in this business, and that's somebody who's done 1 deal.
Mm.
And the reason is, if you can do 1 deal, you're going to do 5 or 10 or 20 or 50 or 500 deals. And so what people need to remember, if you're in that 95% of people that have never done a deal, your sole goal shouldn't be to do 10 deals or 50 deals. Your sole goal should be to do 1 deal, because if you do that 1 deal, if you get from the 5% or the 95% to the 5%, you're not going to stop there. It gets so much easier after that first one, and you will do 5 or 10 or 50 or 100 deals. So don't give up till you get to that first deal.
Love that. Yeah. That's awesome. So Jay, what is your next? What are you looking to accomplish in the next 5 to 10 years?
More of what we're doing now. At this point, we have about 1,000 units. We have a few hundred investors. And so anytime you start raising money from other people, you're making a commitment. And in the multifamily space, deals can take 3 years, 5 years, 7 years. And so the day I decided to start raising money from other people, I basically made a commitment to focus on those deals until all of my investors were paid back. And so right now I'm just focused on doing what I've promised my investors that we're going to do, and do that for as long as it takes to get through all the deals we have or any deals we buy in the future. So that's all I'm really thinking about right now.
Nice.
Yeah. So how can listeners get a hold of you if they want to connect with you or learn more about bar down investments, or maybe participate? How can people reach out?
Yep. Easiest way, if you go to jscott.com, just the letter J, SCOTT.com, and that will link you out to everything you might be interested in. And I appreciate you plugging Drunk Real Estate a couple times.
Yeah.
That's if I had to plug anything on here, listen to that podcast. We started doing it a few months ago just because we just enjoy doing it. I mean, it was just something we love doing. So if we can get people to listen, that'd be awesome.
Yeah. Some great guests, and I think you got 4 people that are very bright, individuals on that show. And I think you guys make it entertaining and share a lot of insights. So yeah, definitely check it out.
Awesome. Well, Jay, it was a pleasure to have you on the show today, and thank you. Go ahead.
Yeah, if we can do anything for you, please let us know. And again, we appreciate it. And otherwise, everybody, we'll see you all next week.
See ya.
Thanks, everybody.
You've been listening to Inside the Wolf's Den, an entrepreneurial journey with Shawn and Joni Wolfswinkel. Tons of entrepreneurial podcasts are out there, talking. But Joni and Shawn are living it every single day. Their portfolio now includes many franchises and medium-sized businesses. We talk about the trials and motivators of successfully running a business. Join us again soon for another podcast. But until then, reach out on the website at InsideTheWolfsDen.com, on Facebook at Inside the Wolf's Den, on Instagram at Inside the Wolf Den. We'll see you again soon. This is Inside the Wolf's Den. We'll see you next time.